Hey everyone, Douglas here, Canon Market Analysis, and I want to talk about this chart right up here. As it turns out, this is one of the most predictive data points for calling the top to the business cycle. Now, I know it doesn't look like much right now, but I promise by the end of this update, you're going to understand why this chart is so important in understanding the global macro picture as a whole. I'm also excited to talk about this topic because it's going to allow me the opportunity to reference someone and their work on economics that I am absolutely indebted to, and whose work has probably influenced me more than anyone else, and that is Professor Steve Keen. His work and research is absolutely groundbreaking, and I'm going to reference a video of his or a lecture of his later, and I'll link to it below. And I think when you watch it, you'll understand why what it is that he's doing is so profound. So if you like this update and you're new to my work here, please make sure and subscribe and turn notifications on as well, so you won't miss another update going forward. And if you find this update especially beneficial, please make sure and hit that like button as well. All right, so average hourly earnings. Why is this such a predictive data point? Well, in and of itself, admittedly, it's not the most predictive thing as it stands right now. We're going to have to work with it just a bit and also understand the economic significance behind this data that will then really allow us to get a grasp on what's going on. So first, what I'm actually going to do is I'm going to try and produce kind of the end product first, and then from there we'll try and better understand the economics and macro implications behind it. So first thing I need to do on this chart is go ahead and click Edit Graph, and instead of looking at the raw number, we're going to change it to the year-over-year rate of change. And immediately when we do that, you're likely going to start to notice some peaks at important points, but we'll build upon that some more in just a second. The next thing I want to do is I also want to overlay the average hourly earnings with unemployment. So, and just for the record, I'm on the Fred site. This is the Federal Reserve of St. Louis data repository. Has nearly infinite amounts of data, great resource, and every investor or trader, anyone who's studying economics should know about this. So it's just fred.stlouisfed.org, and you can follow along at home and recreate everything I'm doing there. Anyway, so we're going to overlay the unemployment data over top the average hourly earnings. So we'll again add line, add data series. So that'll go ahead and put that there. Now the next thing we have to do is go ahead and scale these, and we're going to go ahead and scale the average hourly earnings on the right scale. And the final thing we're going to do is, it's actually already added. If you're doing this along at home and it's not there already, you're going to want to add one final line. If it doesn't show up, and that would be the 0 line, 0, 0, and that should put a black line at the 0 line of whatever's scaled to the left side, which in this case is going to be the rate of change of civilian unemployment. And then we're going to truncate this chart down to kind of show everything that happened from the late 70s, early 80s into where we're at today. So already by doing this, you're probably likely starting to see some things jump off the page, some big spikes preceding some recessions. So what is this actually showing us? Well, the thing, like I said, that jumps off the page here is that whenever the rate of change, that would be the year-over-year change in hourly wages, is above about 4%. So again, that is scaled to the right side here, and the rate of change of the unemployment breaks that zero bound that precedes a recession. More importantly for investors, if you were to overlay a chart of, say, the S&P or the NASDAQ, you'll also notice during the last 3 cycles, it topped almost perfectly with, or I guess it should say that event occurred, the rate of change breaking through the 0 line on unemployment and the acceleration of wages year over year above 4 coincided with the top in equity markets. as well. Now, that in and of itself is quite fascinating, and you could really just kind of take that idea and run, make of it what you will. But as one of my favorite quotes from Ray Dalio goes, don't pay much attention to people's conclusions as to the reasoning that led to their conclusions. And I really like that quote because it really makes you understand what's actually happening, and it should really be a driving force in your thinking. So what is that reasoning that is happening here from an economic side of things? Well, this is where Steve Keen comes into the picture. And what Steve Keen has realized and spent his entire life's work proving is that the economy is a complex system that functions as a dynamic system. And he's actually built nonlinear models to prove concepts like endogenous money and to show the effect that private debt has on the economy as a whole. Trust me, I'm getting somewhere with this. Now, I know that some of these terms may be new to some of you watching this, so like I said, I'll link to that lecture of his below in the description where he'll explain all of this. But one of the more fascinating insights from his work on nonlinearity and the complexity of the economy is the relationship between private debt and the wages share of GDP. In the video, again, that I'm referencing below, he starts talking about this reality at about the 32-minute mark. But the real takeaway is this, that as a private debt load of a nation increases, the workers, because of the way the nonlinear equations function, they are left to carry the load of the rising debt by a diminishing wages share of GDP. And you can actually see that in this chart right here. The red line is the total private debt to GDP, and the blue line is the wages share, effectively the wages share of GDP. And you can see a ever decreasing, or kind of a corresponding decreasing, starting in the 70s and accelerating in through the 80s. Coinciding with the acceleration of private debt to GDP kicking off at that same kind of 70s into 80s time period where private debt really started to take off. And as I mentioned earlier, why I was saying that we need to kind of start that economic cycle chart at the 1980s is because this is when that private debt level really began to take off because of bank deregulation occurring at that time, and that allowed those private debt levels to really start to balloon. And as Professor Keen argues in that video, this ballooning of private debt, not only does this drive corporate profit hires, and that's a really important point to make here to tie all this together, but it also causes the shrinking of wages share of GDP. And that can again be seen in this chart here. So there's that correlation there. So how does this lead us all back to our wages and unemployment data in terms of this being a predictive data point? Well, by kind of reverse engineering what Steve Keen's insights are. And remember, as you watch that video, Steve Keen is an economist. His goal is to teach and have a better understanding of economics. He's not an investor. He's not a trader. That's not what his aim and mission is. But we can reverse engineer those kind of for our purposes. And what we deduce is that when the rate of change of unemployment begins to accelerate, again, above that zero line, and when there's sufficiently fast enough growth in wages, we can pinpoint that moment when wages begin to edge out the profit margins. And it's at this point that corporations are forced to stop their expansion, meaning that credit impulse that has caused the drive in economic growth begins to evaporate, leading to an economic downturn. And that's why we see, and that's exactly what we end up seeing in this chart. That's why we see unemployment spike and the recessions happen. And that's what makes this chart ultimately so predictive. So where are we at right now then, looking at this chart? Well, we are clearly near the end of the cycle. However, I would express patience here. Every cycle is different, and with sufficient fiscal and monetary policy, the end of the cycle could last for many, many months to come, hugging those critical boundary markers before finally rolling over. In other words, don't make this your only tool for measuring where we are at in the current cycle, but certainly don't leave this out of your tool bag either, as it is a very highly predictive, highly accurate tool. All right, so I'm going to wrap this update up here. If you have any questions or comments, please leave them in the comment section below. I'll be happy to engage with you on this. And if you do like what I'm doing here and you're an active investor or active trader, please check out my Patreon page. That's where you're going to find all my research, all my analysis with multiple updates each week, covering all major asset classes. I break it down from both the technical and macro side. And you also get to see my portfolio in each update and all my trades in real time, so you can know kind of where my conviction levels are at and how I am acting on what I'm seeing in the markets. So yeah, I'd love to see you on over there. Anyway, that is going to wrap up this update. So as always, good trading, everyone, and we'll see you next time. Bye-bye.